Good morning, everyone. So welcome back from reading week. This is week 8 of ratio analysis. We just completed week 6 and 7. This will be the final week before our next 15% test. So this test and upcoming assignment that are due are both only worth 15%, as it only has 3 chapters and a little bit less material, although it will have some more critical analysis questions. So this week we're going to go through ratio analysis. I have included some review activities and review information based on last week's cash flow statement. Many of you seem like you really understood what was going on, and you did understand the pattern on how the payment schedules work. So as a very good example, in January we have $25,000, and the cash payment schedule was 20% right away, 60% in 30 days, and another 20% in 60 days. And we were able to realize that doing this, we always have this diagonal pattern showing the $25,000 being divided up amongst those 3 months, like so. You all felt pretty solid about that, which brings us into ratio analysis. Now, when it comes to ratio analysis, you will be given all of the formulas, or at least have access to the formulas, and there are many of them. What the idea is with ratio analysis is that we will be looking at companies and ourselves and saying how do we rank compared with, again, industry or historical norms, as well as against competitors and other companies. So ratio analysis is referring to the comparison of two figures. These could be numerical, like numbers, or they could be quantity, so 1 or 1.5 or just 2. And usually we take both a look at the balance sheet and the income statement, and it could be numbers from both to determine these different ratios. So let's take a look. So ratios can be expressed in a couple different ways: a percentage, a numerical value, a quantity. So don't be confused when we do ratio analysis and you get 40%. It can be shown in many different ways, as is shown here on the bottom of this slide, where we can look at a ratio as 2,000 over 5,000, or 2 over 5, or it can show as 40%, which is 2 divided by 5, or you might even see it like this, 2:5, which is 2 to 5 as well. So this is, or 2,000 to 5. So this is all different ways that we can express it. It all shows the same number, just in different varying forms. So here they're saying they have a total current liabilities of 2,000, total current assets of 5,000, and they're doing this quick ratio of 2 to 5, or 40%. So what does 40% mean? So it means that our total current liabilities is 40% of our total current assets. So a current ratio is a little bit of the inverse. So a switch where we take our total current assets and we divide it by total current liabilities. So this is just a way for us to express this ratio: 5,000 divided by 2,000, or we lower it to its base common denominator, which is 2.5 to 1. So this is called a current ratio. Basically, this means that at any time, our current assets are 2.5 times greater than the total current liabilities. So we could pay off our current debt 2.5 times. So that's basically that number that they're looking for. If it's not 1, and we talked about this in previous courses, if it's not 1, that's usually a danger sign. Anything over 2 is fantastic, and most companies fall in between that 1 to 2 range. So how do we use ratio analysis, or why do we care, I suppose, is a good question. So we use standard ratios such as industry averages. It can be useful, but not always. We also use comparable ratios from similar competitive organizations. So we've talked about occupancy rates, and we've talked about revenue per available room, and we've talked about food costs and all of these. And these can be ratios, and this is how we might look at our gross profit ratio, ours, and also in comparison to others. We also use current operating period ratios with previous operating period ratios, and this would help us with trend analysis. So in the month of January, our current ratio was 2.5, which means we could pay off our debt 2.5 times. And then come February, it was 2.2. And then March, it was 2.1. And then in April, it was 1.8. And now you can see the trend that we are slowly losing some of our current assets, or we are increasing our current liabilities. So we're either not as liquid as we once were, or we're increasing our debt too much. We can also use a predetermined standard for that operating period as well. So a couple things you want to say is who will be using these ratios and who can be expected to know them. So first of all, your internal operating management. So these are yourselves potentially. So we want to use these different ratios to monitor our performance. Ratios are just a really great measurement tool to see if you are doing well. It could also be current and potential creditors. So they are more interested in assets and interested in ratios that indicate that they their investment is safe. So they will get either their loan back, or they can invest money in you because you are doing well and the stock price may grow. And then also organizations, owners. So these are the owners. So this is them measuring their risk of investment, the return on investment, and just the probability of success. So they've broken these ratios down into 5 different categories: liquidity ratios, profitability, activity, long-term solvency, and operating ratios. And we'll go through a few of them. So first one is liquidity ratios. So I'll have a Skyline investment information for you. So it'll basically just be the Skyline Investments, which is the company that owns Horseshoe and Deerhurst. I'll have a PDF that you are able to look up to find these numbers, just to give you something relative and real to look at while we're looking at these ratios. Because a lot of it's kind of gobbledygook until you see it in real life. So liquidity ratios identify the relationship between current assets and current liabilities. These are the types of ratios that help evaluate the ability for a company to meet its current obligations, its current debt. And there are a few of them. These are the most common. So there's a current ratio, a quick ratio, a debt ratio, and a debt to equity ratio. So if you were to look at your Skyline investments, you would be able to see the current ratio for both years. Wow, spelling mistakes everywhere. Is current assets divided by current liabilities. And here in 2017, it was 1.45. The current ratio in 2018 was 1.28. So in 2017, they were a little bit healthier than they were in 2018. They are currently in a worse financial position if you just look at the current ratio. These are the other ones that you can do as well. So the asset test is total current assets minus inventories and prepaid expenses. So it's using a little bit less money. Basically, the reason that they do this is they say, if you go out of business, you may not be able to sell your inventory. You may not be able to recoup your prepaid expenses. So let's really take a look at what kind of current assets you can actually get use of. The debt ratio is kind of just the total liabilities divided by the total assets. So it's a little bit more long-term. And this ratio tells us for each $1 of assets the business has, it is financed by X number of equity and X number of debt. So anything close to 1 is bad. And the hospitality range is usually 0.6 to 0.9 because hospitality is a very risky industry when it comes to lots of businesses, really. And then the final one here is the debt to equity ratio, which is liabilities divided by total equity. And this one tells us that for every $1, the stockholders have invested a certain amount of money. So we want to take a look at this as well to see, again, how we are doing, how liquid we are. Next one is profitability ratios, which is a little bit easier to understand. So this indicates the management's effectiveness in using their resources. So how well do you manage your money? So these are a few of the different ratios that we would look at: return on assets ratio, profit to sales, return on equity, return on total investment, earnings per share. This is all stuff that we want to take a look at. And one of the most common ones is the gross profit margin, which is revenue minus cost of goods sold. You know that's gross profit, right? How much money do we make? What did we have to spend to make it? divided by revenue. So you'll see there's Skyline information here for 2016, 17, and 18. And it basically just says this is the amount of revenues that they made. This number here is the cost of goods sold for each of those years. And then we divided it by their revenues. And they kept 15.8%, 16.4%, and then in 2018 they kept 21.3% of their profit. Now, this is still fairly low as far as the industry, or compared to other industries. In our industry, it's not bad, but year over year, Skyline Resorts is performing better. But as a good example, when we looked at our current ratio a few slides ago, Skyline Resort in 2018 was in a worse financial position. This highlights the fact that you really need to take a look at a bunch of these different ratios to understand how a company is doing. For liquidity reasons, maybe they're not doing fantastic, which means I worry about the fact that they are going to be able to pay their debt if that trend continued. As far as profit, from 2017 to 2018, they went up over $60,000 in profit, and they're keeping over about 5% more of that profit. So those are good things. Other types of profitability ratio are the following: operating income return on investment, net profit margin. So instead of gross profit margin, this is net income. So the final line in that income statement, what do we actually keep? The bottom line, as we call it, and then return on total assets, which is net income divided by total assets. So how much stuff did we have to use and do we own in order to make a certain amount of money? So those are some of the profitability ratios, and it's important to remember that there are many. There are probably hundreds, if not maybe thousands, of different ratios. There will not be one that I won't give you. The idea of all of this is that you will be given the ratios, you'll know the formula, and you'll probably know what it says, what you're going to be looking for. But what you want to do from this is say, okay, me as a smart fourth semester, third semester hospitality future grad, can I look at this actual information and come up with some critical analysis? And you're probably sick of hearing that question, but it's just thinking for yourself. Am I smart enough to look at this and say, this is a healthy company, this is an unhealthy trend, this seems interesting, this could be trouble? I want you to be able to really break down these items. The next one, so this is number 3 of 5 different types of ratios, is long-term solvency. So these are also known as net worth ratios. And these measure a company's ability to meet its long-term. So the liquidity ratios was to meet its current or short-term obligations. This one is more long-term obligations. So some of the ratios are total assets divided by total liabilities divided by total assets. So that's just the inverse. Cash flow divided by total liabilities. There are a ton. One of the major ones that we look at is the debt to equity ratio. So how much debt do I have and how much is my company worth? So it indicates the degree of financial leverage being used by the business and includes both short-term and long-term debt. Any increasing debt to equity ratio is bad. So if we do it for Skyline Resorts, we know that in 2017 we have 1.412. And in 2018 we have 1.607. So we have an increasing from 2017 to 2018 debt to equity ratio. We have more debt than we did the year before, compared to how much our company is worth. So this is how much debt that we had, and this is how much equity that our company was worth. A standard good debt to equity ratio is 1 to 1.5. Anything above 2 is considered bad. We are in that kind of okay zone, but you would look at this and say, okay, you're above 1.5, you're starting to trend the wrong way. In 2019 and 2020, you would have hoped to see that number go down, not up. A couple other long-term solvency ratios are debt to assets, so total debt divided by your total assets, and your operating income divided by your interest expense. Now, I'm not going to go through and read every single line here. I do expect as you go through, if you would like to read a little bit about what each of these ratios means, please do so. Debt to income ratio. So why I have a whole slide set aside for this one is because this one is very important for yourselves in your personal life. So how much debt do you have and how much income do you make? This is basically going to allow you to borrow money depending on what these numbers are. So the DTI ratio is a personal finance measurement that compares an individual's monthly debt payment to his or her monthly gross income. So monthly debt payment, not the entirety of your debt. Your gross income is your pay before taxes and other deductions are taken out. The debt to income ratio is a percentage of your gross monthly income that goes to paying your monthly debt payments. So why does this matter in your life, or why would you care? If you ever want a mortgage, which means to buy a home, and I'd say everyone here would like that opportunity, the highest number that this can be is 43%, which means that you can't pay more than 43% of your monthly income to service a mortgage or to pay for your home. They won't give you a mortgage if it's higher than that. So if there's a house but you have to pay $2,000 a month, you have to make sure that $2,000 a month to own that home, you have to make much more than that. So you'll have to make over $5,000 in which to be able to fall within that 43%. $5,000 a month is a lot of money. So money lenders want to see between 28 and 36. Basically, the lower the better, and the lower that this rate is, the better interest rate that they can give you. Now, it might be confusing a little to some of you. Some of you, this might make perfect sense. But basically, having less debt, so this is not only your mortgage, but ensuring that you don't have crazy car payments and crazy school debt, and you have credit cards that have maxed out and that you require a lot on there. All of this stuff they'll take into account, saying, okay, you can't pay more than a certain percentage of your income to service all the debt, because you still need to put gas in your car and food on your table and go out for a night or buy some clothing or medicine or whatever it is. So this is a very important ratio for you to understand. Please keep this in mind as you just go through life, especially when you sign on to get that new credit card, or you say, yeah, it's fine to take an 8-year high car payment. It might be really hurting you for some future moves. So just be careful, that's all. There's two left. So next one is activity and turnover ratios. So this looks at all kinds of stuff, but this could be your inventory turnover ratio, your average days that inventory sits on your shelves before they are sold, working capital turnover, fixed asset turnover. So a fixed asset might be like property, plants, and equipment. So how many times do you need to change out your washer and dryers in your housekeeping area? How many times you need to buy new deep fryers or things like that. So these are expressed in a number of different ways. Inventory turnover ratio is actually a really important one because these are depending on what we're talking about. If you're a retail store, it's not as important. So if you're talking about your American Eagle and how many jeans do you sell and how fast do they sit on the shelves before they are sold, they're probably looking at more of a seasonality thing where we want to make sure that we sell our spring line before April. So we can bring in the summer line or whatever that might be. As you can see, I haven't worked in retail a whole lot. But when it comes to perishable goods, which we often deal with, this inventory turnover ratio, we want to see several times a week, 2 times a week, maybe 3 times a week. Because let's say we buy all of our produce on Monday, our turnover ratio shouldn't be 7 days, because that produce on Monday will not last 7 days. It will not be healthy. We cannot serve it. So we want to be able to flip this 2, 3, really the more the merrier when it comes to perishable goods. Alcohol, we wouldn't worry as much because it has a higher longer perishability. So a bottle of beer can last six months in the fridge. Keg can last a couple weeks. But you still want to see a fairly good turnover so they're not sitting on your shelves too long. And then another one is operating ratios. So these are things that we have already dealt with quite a bit. So this is your food and beverage cost percentage. This is your labor cost percentage, dollars of revenue. This is your average checks or your beverage checks. So every time someone comes in my restaurant, I know on average they spend $43. Seat turnover. Percentage of beverage revenue to food revenue. So usually it's 70-30 for most restaurants. 70% of their sales comes from food, 30% from beverage. But if you're a pub or a bar, it might be more 50-50. If you're a hotel lobby like Martini Bar, it might be 70% alcohol, 30% food. Now, we always want a higher beverage revenue because we just make more money. That's why like nightclubs can be open just Friday and Saturdays and then be closed the rest of the week, because they make so much money on those 2 days because beverage revenue markup is insane. Costs about $1 for an ounce of vodka, but I can sell a 2-ounce martini for $10. So these ratios cannot typically be determined by looking at annual reports. This is more of an insider working knowledge of the business. You need to know costs. You need to know what you're charging. Annual reports won't get this for you. So this is essentially what I'm talking about here when it comes to ratios. When it comes to our 2 different assessments for week 8. I don't have the in-class activity with me now. I will post it as soon as I can. Here is the ratio analysis. Now, I'm sorry, this is also the Georgian College Microbrewery. So not to confuse anyone in the assignment, the title of the place was changed, but it wasn't down there, but it is the same company. So this is an income or a balance sheet here for the Georgian College Microbrewery, and this is also the income statement. What would be required of you is to go through and to do each of these individual ratios. So this is the formulas for everyone, so you just got to go through and determine it. It shouldn't give you much trouble at all. Basically, all you're doing is just finding the number, dividing it by the other number, and coming up with the answer. So really, it's just kind of a click and play. Now, the next part is the operational analysis, where it gets a little bit more difficult. So here we have this Georgian Lodge Resort and Spa. I've gone through this a little bit with you if you've come to some of the classes. They offer a hotel, a restaurant, and a spa. So we have 3 different revenue areas, 3 different departments, all of which have different numbers, all of which have different ratios that we can come up with, percentages that we can come up with. So what we have asked you to do here is find out all of the following. I'm not going to help you find these out. This is where it becomes, okay, I've been in this course for 8 or 9 weeks at this point. I should be able to go through and do my own analysis, so I'm not walking you through any of this. I want you to tell me what all of these mean. And then at the end of this, once you have all of your numbers, that critical analysis comes into play. So now you're going to start breaking down the rooms division, the food and beverage division, and the spa division, and give me an evaluation of what you think is going on there. Are they doing well? Are they not doing well? How do I know if they're doing well? And if you don't know how, what are you guys going to do as students to go figure it out? Because when I say these are industry averages, that means almost worldwide industry, definitely North American industry. So you are a Google search away from finding out what an industry average is if you don't already know it. So I'm looking for depth when you write these answers. I don't want you to say, well, it looks like the food and beverage department has a high labor cost. What is a high labor cost? Pretend that I am an idiot and I know nothing. Shouldn't be hard. So just go through there and say, okay, based on the industry average of labor costs being 30%, 35% labor cost here seems quite high. I would take a look at somehow changing my schedules or looking at the hourly rates of my employees. That is a more detailed answer, and that's kind of what I'm looking for. So please go through all these, answer them as much as possible. We have class on Monday and Wednesday. I will go through the ratio analysis with you, answer any questions you might have. I'm not going to go through the operational analysis, but you can ask me a couple questions about, just if you're confused with the formula. And that is it. So other than that, I hope to see you soon. Have a great week.